Hello, everyone. Welcome to today's home buyer seminar. My name is Linda Blue. I am your local realtor, and we have Mr. Ron Stewart. He is with Ace Credit Repair, and we're going to have Miss Veronica Villafano, who is with Streamline. She's going to be speaking about your credit and your lender. Well, not your credit, but she's going to be speaking more of the financial aspect. So she's going to be joining us shortly, but we wanted to go ahead and get started just to respect everyone's time. Thank you so much for those who are viewing. Remember, you will get a copy of this presentation afterwards. So in case you have any questions, you can definitely reach out to us and we can answer those questions for you. So a little bit about me. I am a realtor, but I was a former teacher. I taught for over 10 years in HISD. And what I discovered is that a lot of times teachers were not homeowners. And a lot of times it was because we as educators have to have those degrees to become educators. And when we get those degrees, we are saddled with a lot of the student debt. So we're going to speak about student debts and we're going to speak about different programs that we are going to, that you might qualify for. So Miss Veronica Villafano, she, like I said, she's going to join us. She is with Streamline Home Loans. She's a senior loan officer, and she will be able to answer all those questions that you might have on how to get the best loan product that fits your needs. And also we have Mr. Ron Stewart. He's with Ace Credit Consultant. He's going to tell you why it matters to have good credit and what he has to offer and how he can help you get that good credit to get you into your new home. So the famous quote is, don't wait to buy real estate, buy real estate and wait. And the reason why this is a great quote is because a lot of times what happened with the market within the last couple of months, the market was really hot. And a lot of times people were waiting. Well, we're trying to wait because there were multiple offers. The interest rate all of a sudden went from 3% all the way up to 7%, and it varies. So a lot of times people want to wait to buy that real estate, and they don't realize what you could buy today is not what you're going to be able to buy tomorrow. And a lot of people who waited and wanted to see and waited out and expected the prices of the homes to go down, they're getting a rude awakening now, realizing that that house that they could afford, they can no longer afford that house. So we're going to talk about why it's important to find what you're looking for and how you can make that dream come true. So today's goals are the steps involved in the home buying process, 2, how to qualify for a mortgage, and 3, why credit matters. And if you have any questions, make sure you drop them in the chat box where we can definitely answer those questions. And Veronica has joined us just in time. So we're going to talk about the important timelines. When you are buying a home, a lot of times people do not know where to start. The first thing you need to do is you're going to have to get with a lender. Now, the lender is going to do one or two things. The lender is going to give you a pre-approval, or the lender is going to tell you, okay, this is the things that we can do, are the steps that we need to do to get you into that home. And they might say, okay, your credit is not where it needs to be. So they might refer you to someone like Mr. Ron to help you get that credit where you need to be. Once you get that pre-approval, you will be sent to me, the realtor, to help you identify your home and the wants and needs you have. After we find that home, you're just going to simply execute that contract. You're going to have your money ready for the option period. You're going to get the home inspected, and you're going to do a couple other things that I will help you throughout the process. Once that is done, the next step is going to be closing. So it's basically 4 steps that we can group everything into to make this process as easy and streamlined as possible. So this is going to be where Ms. Veronica is going to jump in, and she's going to talk about the 5 questions that buyers normally ask their lenders.
All righty. Thank y'all so much for having me. So let's rock and roll. As a mortgage lender, we get asked lots of questions, and here's the thing: there's no question too simple or too silly to ask us. The more questions you ask, the better you're going to feel, the more confident you're going to feel about your journey to home ownership. And it's super important that you feel comfortable and you feel heard as a client and as a future homeowner. So let's jump in. Lender's Corner, some of the top most common questions I get asked, and I get asked lots of questions. The first one, what's the minimum credit score I need to have to buy a home? So we can actually go down to, typically lenders can go down to a very standard 580 credit score. That's the gatekeeper. Sometimes lenders can go down to below a 580, closer to 500. That typically requires a higher down payment though. Typically you're looking at 10% versus 10% down at between 500 to 579 versus when you're at a 580 or above, you can benefit from lower down payment requirements, which we'll go through in just a minute. But that's typically anywhere between 0 to 3.5% down payment. Number two, actually, do I really need 20% down payment to buy a house? Absolutely not. Let me bust that myth. It's a big myth, and it's actually a very common one. You do not need 20% down payment to buy a house. If you're being advised, maybe from parents, grandparents, that during their generation of home ownership, banks and lenders typically did require larger down payments back then. But times have changed. Our amazing country understands that it's very hard to save 20% down to buy a house. So there are programs, there are things in place that help you to become homeowners with much less out of pocket. Number three, rising interest rates. With rising rates, is it still a good time to buy? Absolutely. The reason I was 2 minutes late is because I was actually just on a conversation on a Zoom with a client that had this exact question. Veronica, rates are rising. Should I buy or should I rent? Let me rip the Band-Aid off. Guys, rent is 100%. The interest rate on rent is 100%. When you rent an apartment, when you rent a home, unfortunately, you're paying someone else's mortgage. You're not paying your own. So if I am in a financial position, there's seasons for everything. Being in a financial position to be able to buy, if I can buy and if you can buy, absolutely. Buy now. You can always refinance your loan later. When you refinance, that means you keep your home, but you get to change the terms of the loan. So refinancing, typically the benefit to refinancing is you lower the interest rate to wherever we're at in the market. Number four, when can I refinance my loan? Immediately. We usually like you to make your first couple of mortgage payments just to make sure everything gets handled from the mortgage servicing side, but you can refinance your loan at any point in time. It's really important to ask your lender because sometimes there are penalties if you pay off your mortgage too fast. Some, like down payment assistance programs, require that you keep your loan and that rate for about 3 years. So yes, there are times when you cannot refinance or you should not refinance sooner, but just make sure to ask your lender that question as well. But really and truly, in general, you can refinance at any point in time. Number five, lastly, how do you pick a great loan officer? Guys, you are about, as a loan officer, you are about to share some very personal, confidential information with me as a loan officer. I respect the fact that you're going to share more information with me than you're probably going to share with your siblings or your family. And, it's something that a good loan officer should treat with respect. And I say that because we, as good loan officers, a good LO should be great at communicating, great at explaining. You're probably here because you're looking to buy your very first home. So can you communicate? Is a loan officer explaining things very clearly? Do you feel good? Do you feel comfortable? Of course, you can always Google. I know anytime I want to buy something, I go to Google and I look at ratings. Yes, you can go to Google. At the end of the day, trust your gut. Okay, next slide, please. So how much do I qualify for? There is something that loan officers look at when qualifying you for a mortgage. Think of the acronym CIA. Okay, so when you speak with a loan officer, the three most important things that we're going to ask about are C is credit, I, which is income, and then A, which are assets. And all three are equally as important. So a third in terms of importance. So, from a credit perspective, let's jump into credit. Credit is, we look at the credit score. Again, that's the gatekeeper. After that, we're going to look at your credit history. Have you paid on time? Also, we're going to look at how much do you owe in compared to how much can you take out in credit. So if you have $1,000 credit card limit and you owe $900, that's a 90% debt to credit ratio. That's kind of high. So credit is, if you were lending your neighbor $200,000 to $300,000, would you want to see, a good, what would help you feel more comfortable of them, the fact that they would actually pay you back? Well, the way lenders look at it is we're going to see historically, how have you treated your other credit history in the past? Even just a $500 credit card, a $200 credit card. Did you pay it on time? Do you keep a low balance? Have you paid it off? Things like that are important. The second one is income. Typically, we want to see your income history, employment history for the last 24 months. Technically, you can buy a house with just a 12-month income history, but typically lenders want to see 24 months. Where did you work? Okay, and it doesn't have to be at the same company, but we want to see, has there been stability of you working? If you moved, why did you move? Did you, did you go to make more money? Were you laid off? That happened a lot during COVID. So be prepared to provide the last 24 months of your work history. And then also, things like pay stubs, tax returns, W-2s, those are the documents that help lenders really paint the picture of who you are income-wise, okay? Lastly is assets. Assets, it costs money to buy a house, okay? And the money that it costs to buy a house, we want to know, where's that money coming from? Is it coming from your checking, your savings, a retirement account? 401k, if you have one, is a really popular tool that a lot of families use to buy a house. Are you getting a gift from a family member? Are you utilizing down payment assistance programs? Where's the money coming from? That's all we want to know. Most importantly, no cash. So if you're a cash buyer, you don't like to, owe money, you like to pay everything in cash, just stay away from cash deposits. It's a really, really big deal in our world, in our lending world. From an asset perspective, know that we're going to go back the last 2 months. So credit, typically the last 2 years, income, the last 2 years, and then assets, the last 2 months. Next slide, please. Do I need 20% down payment? Absolutely not. So just as I mentioned earlier, down payment requirements can range anywhere between 0 to 3.5%. A 0% down payment is typically reserved for our veterans. If you're a veteran, thank you for your service. You may qualify for 100% financing. There are USDA loans available. That's if you're buying more in the rural areas of Houston or like in the suburbs of the suburb. There are certain income limits to that, but it is a 0 down payment program. Recently, we released a 1% down payment program where you only have to put 1% down on a conventional loan. There are other loan programs like conventional and FHA where a lender is going to require anywhere between 3 to 3.5%. You just don't need 20%. Okay, so don't let that stop you. What are your options for financing? We went through that already. When your lender looks at your paperwork, so if you call me and say, hey, what kind of loan can I get? I'm going to ask you, well, who are you financially? Because each of those loans that I just mentioned, conventional, FHA, USDA, VA, all of those have very different requirements that it is my responsibility as a loan officer to know, understand, and get you qualified for. Sometimes clients can qualify for several loan programs, and if you do, a good lender is going to advise you and give you that option to choose what loan program you want to go with, because there are differences. So just know that you may have options. Sometimes you may only have one option. I get asked all the time, Veronica, what's the best loan? And I say the one that gets you into the house. Okay. Mortgage insurance, what is it? As I mentioned, the different loan programs, VA, USDA, conventional, FHA financing, each of those loans have their own requirements, but they also have their own benefits. Some loans, like VA and USDA, do not have mortgage insurance. Mortgage insurance is the insurance that protects us, the lender, in case you default on your mortgage. Loans like FHA and conventional do have mortgage insurance typically, and the amount of mortgage insurance, or PMI, MIP, it's all the same thing. That dollar amount is going to depend on the type of loan program. So make sure that your loan officer is explaining to you what is mortgage insurance, how much does it cost, and will it ever go away? Okay, next slide. What are closing costs? So think of when you buy a house, it costs money to buy a house. You have your down payment, which goes towards your loan, okay? And then you have your closing costs. Your closing costs are going to be the actual fees that it costs to get into the house. So the closing costs include lender fees. That's what we charge to the loan. I wish our services were free, but it costs money to buy a house. So you have your lender fees that the lender charges. You have third-party fees, which are typically your appraisals, your inspections, your credit reports, title companies, things like that. Lastly, because in one transaction for one closing, there are multiple people that are involved in getting you to the closing table. Gratefully, you don't have to communicate with all of those, all the people, all that whole village that gets you into a home. The only people that you really have to communicate with is typically the lender and your realtor. Okay. Lastly, prepaid costs and escrows. These are things that you prepay in advance to get you into your home. Typically, a prepaid item, the most common is going to be your home insurance. In general, lenders ask you to prepay 1 year of homeowners insurance at the closing. And then we're going to set up your escrow account. Just briefly, an escrow account is where you pay your total mortgage payment to the lender, but part of that mortgage payment includes your property taxes and your homeowner's insurance. It's 1/12 of each amount of each bucket. You pay that total to the lender. Let's say your total payment's $2,000. Well, of the $2,000, the lender sends the principal and the interest money back to the loan to pay it back. And then the last part of that is your mortgage insurance, the property taxes, and the homeowner's insurance that goes into your escrow account, your savings account. And at closing, you're going to typically pay a little bit, a couple of months in advance of taxes and insurance to set that up. Next slide. Pre-qualification versus pre-approval. It's so important to make sure that your lender is working through, most importantly, getting you pre-approved. Okay, and the reason why is pre-qualified. If you're pre-qualified, that means that lenders, maybe they ordered like a soft inquiry, or maybe they just took the application over the phone and say, hey, based on our conversation or based on your application with no documents, you should qualify for, $300,000 or $200,000 or a VA loan or FHA loan at this interest rate. That just means based on conversation and some basics, we've kind of pre-qualified you verbally. Pre-approved means that we've gotten nosy. You want your lender to be nosy. And the reason why is because when we get nosy, we find out the true, if you tell me, hey, I make this much money, but I look at your pay stub, that pay stub is going to paint it may paint a little bit of a different picture of what you actually earn. The cool thing is that we give you credit for your gross income before taxes are taken out. And sometimes when our clients apply, let's say for example, they put what they take home versus what they actually get, what they actually earn before taxes are taken out. So make sure that you get pre-approved and not just pre-qualified. That means that we've looked at your application, your credit report, and your documents. Okay, next slide. And then lastly, how does my credit factor into a loan? The credit is super important. Your credit score is going to be your gatekeeper. The credit score is also going to determine what is your interest rate. Typically, better credit scores mean lower interest rates. How much down payment do I need to put down? That's super important, especially on conventional. Higher credit scores mean lower down payment requirements. and how much of a loan can I get qualified for. I'm not going to dive too much, too deep into credit. We have Mr. Ron here that's going to really dive deeper into credit later. But credit is a huge, huge part of your loan. Again, it's 1/3 of what we look at when we get you qualified. Okay, and that's it. So, okay. So now I think Linda's jumping back on. There we go.
Yes, thank you so much, Ms. Veronica. We're now going to go ahead and introduce Mr. Ron. He is a credit specialist, and he's going to go ahead and explain to you why it's important to have good credit when it comes to buying a home. Go ahead, Mr. Ron.
Thank you, Linda, and thank you for the opportunity to be with you today and talk a little bit about credit. Uh, Credit is something that is a little more complicated sometimes than a lot of people think. And so my goal today is to share with you some information to give you a better understanding of how the whole credit system and particularly the credit reporting and scoring system works, the impact of your credit score, and hopefully some information that'll help you get the best possible credit score and keep it. So what exactly is a credit score? Uh, Typically, it's a number from 300 to 850 that is supposed to indicate, as Veronica indicated, how much of a risk you are to pay back the loan that or the money that somebody lent to you, whether that's a home loan, an auto loan, credit extension of a credit card, or what have you. Next slide, please. So, like I said, we're going to cover the good, maybe the not so good, and maybe some of the secrets about how the whole system works. Next slide. So, how is the credit score calculated? So, whenever you've got a loan or an extension of credit, let's say with a credit card company, all of those creditors, or most of them anyway, will report to the three credit bureaus or one or two of the credit bureaus. So they fill out a form that's got every piece of information on that account on it. And that comes into the credit bureaus and they feed that into a computer. The computer has what's called a scoring model, some software in there that looks at all that information and ultimately spits out that 3-digit number. So what goes into calculating the score? This pie chart kind of breaks it down. 35% is your payment history. How well do you pay your bills? Do you have any late payments? Do you have any charge-offs or collections? Right behind that at 30% is how much you owe. And for credit scoring purposes, when they talk about how much you owe, the heavy emphasis is on your credit card debt. So why is that? Well, if you don't pay your auto loan or your mortgage loan, they can get the house or the car. So that is what is called a secured loan. If you don't pay your credit card, the credit card company simply loses all that money. So 30% is heavily weighted in that area. 15%, how long you have had credit. 10%, what is your credit mix? How much what they call revolving or credit card versus installment loans, such as your mortgage or your auto loan. And 10%, how much new credit that you have. Next slide. So what are the ranges between good and bad credit? You can go to a number of different sources. These particular numbers happen to be from Experian, the largest of the three credit bureaus. So if you're 750 or above, that is an exceptional credit score, and particularly from a mortgage standpoint, and Veronica can validate this, but typically you're going to be qualified for any type of mortgage program that is out there. When you start coming down from that, uh, again, you get into these different brackets, but basically what that means is as you start coming down from that high score, that means that you are going to start paying higher interest rates for things. And that could be on your credit card interest rate, could be your mortgage rate, could be your PMI, your private mortgage insurance rate, homeowners insurance, auto insurance, and so forth. Once you get down to a certain point, and Veronica indicated from a mortgage standpoint, 580 is kind of a magical number in the mortgage world. Once you get down below 580, that is not a good thing. And as we'll see in a minute, that can put you in a position to where you are paying a lot more for things than you would if you had a better credit score. Next slide, please. And again, these are just the different brackets from Experian. Next slide. So most people think, when I ask the question, how many credit scores do you have? Most people are going to say 3 because they're aware of the 3 major credit bureaus, Experian, TransUnion, and Equifax. Well, actually, all of us have probably at least 50 different credit scores. FICO, or Fair Isaac Corporation, by far and away the largest provider of those credit scoring models that go into the computer to calculate the score. FICO alone has 31 different scoring models that they've come out with over the years. And each one of those is different for different industries. So mortgage is different than auto lending. Auto lending is different than credit cards. And then you've got Vantage. Vantage is another provider of those scoring models. They were formed in 2017 by the 3 major credit bureaus. And so now you've got different scoring models from Vantage. And by the way, for those of you familiar with Credit Karma is a Vantage score. So where it gets confusing is a lot of people go online, whether it's on Credit Karma to the credit bureau. You can get credit scores now from most of the big banks. So let's say you go online and your Credit Karma score is 630, and you know that the loan officer has said if you're over 620, you're going to qualify for this particular loan. Well, that's wonderful, but then they run your mortgage FICO score, and those scores are almost definitely going to be different. So if you're going to get a home loan, there are only 3 scoring models that they use for mortgage. Doesn't matter what mortgage company you go to or where they get their credit reports and whatnot from, it's going to be those 3 scoring models that are going to be used when it comes to approving your loan and determining what the rate is for that loan. Next slide. So some recent changes. Few years ago, they decided, the credit bureaus did, that tax liens and judgments were no longer going to be reported by them. And the reason for that was they found that in a lot of the tax liens and judgments, the information was not accurate or complete enough to prove beyond a shadow of a doubt that that particular judgment or tax lien belonged to a specific individual. So now the lender obviously wants to know if you've got an unpaid tax lien or judgment, and they're going to find out. And they will be taking it into account when it comes to their underwriting, but it will not affect the credit score. Credit freeze, for those of you that don't know what a credit freeze is, it's kind of like taking your credit report and putting it in a vault, closing the vault, put some armed guards outside. Reason for that is because of all the hacking that's gone on recently, and in particular back in 2017, Equifax, one of the credit bureaus, got hacked, and 140 million of us had our information put at risk. So I strongly recommend that you do freeze your report to protect yourself. You can do it online. You do have to go to each one of the credit bureaus individually. Relatively simple process, but I really do recommend that from a protection standpoint. Fraud alert is a little bit different. Fraud alert comes into play if or when you have been a victim of identity theft or suspect that you might have been a victim. If you know you've been a victim, you can do it for as long as 7 years. If you suspect you might have been a victim, you can do it for up to a year. So basically, the way that works is you can contact one of the 3 credit bureaus, tell them you want to put a fraud alert on your account. They will walk you through that, and then they will also share that with the other 2 credit bureaus, so you only have to do it once. So the way a fraud alert works is once you've got that on your report, and then you do want to take out a loan, it is going to force that creditor to call you so you can prove that you're you instead of somebody over in Afghanistan trying to open up an account in your name. If you are ever a victim, the first thing you want to do is file a police report. That police report is going to be the document that is going to be the most important in removing items from your credit report that don't belong to you. Next slide. So some other recent changes on the medical side. Effective July 1st of last year, a couple of things changed. Number one, paid medical collections would be now automatically removed from the credit report. So why is that important? Well, typically when you pay a collection, it does not remove it from the credit report. And in some of those credit scoring models, in particular, those credit scoring models used in the mortgage industry, if you pay a collection and it doesn't get removed from the credit report, it's probably going to hurt your score almost as much as if you hadn't paid it at all. So very important that these paid medical collections are being removed. Also, in the first half, the other change that happened July 1st of last year, they extended the time that a collection company has to sit on a medical collection before they can report it. Used to be 180 days, now it's a year. In the first half of 2023, and they're still going through this process, all medical collections under $500, paid or not, will no longer be put on the credit report. So why is that important? Before this, even if you had a very small medical collection, we had a client whose credit scores were in the 730s. Everything was looking great for his home loan. 2 weeks before closing, they pulled a credit report, and there was a $28 medical collection, and that $28 collection impacted his score by 100 points. So very important. This is going to be a real benefit to some people that have some small medical collections. Now, in some of the scoring models that are out there, particularly the Vantage scoring models and some of the newer FICO models, medical collections are either excluded or impact scores less than other types of collection. That is not true for the mortgage scoring models. So if you've got an unpaid medical collection out there, it's going to impact your score as much as if you had a collection for a credit card or an auto loan. Next slide. So, how do you maximize your credit score? Well, one of my favorite sayings is that I never like spending time, energy, and money fixing something that could have been prevented in the first place. So a couple of things. Number one, have a budget and have a safety net account. Know where your money's going. And as Linda indicated, I think earlier, obviously, we go through times when people lose their jobs, whether it's COVID, whether it was the downturn in 2008, 2009. So if you're living paycheck to paycheck and you lose your job, all of a sudden you don't have enough money to pay all your bills. Now you maybe have to start having late payments, or in a worst case scenario, charge-offs or collections. That impacts your credit score. Now you're paying more for everything. It's just a bad downward spiral. Most professional financial experts will recommend that you have 6 months worth of income set aside that you can fall back on if you do run into a nasty financial situation. Pay your bills on time. I guess that should go without saying, but hey, stuff happens. I don't know how you all get your bills, whether you get them online, whether you get them in a snail mail, but you can get the bill and say, yeah, I got to take care of that. And then you get busy and you forget. So one of the things you can do to make sure your bills are paid on time is put them on auto pay. That means the bank is going to pay that bill every month on the same day, and you don't have to worry about it, assuming, of course, you got the money in the bank. Have credit. If you don't have credit, it can be difficult to get credit. So what they ultimately or minimum like to see is 2 credit cards and 1 installment loan, such as an auto loan or a mortgage. Next slide. Should you close credit cards that you're not using? Typically not, for a couple of reasons. Number one, the more available credit that you have, the better. And secondly, if you've got credit cards that you've had for a long time, but you're not using them, and then you close them, if you remember back to our pie chart, 15% of your credit score was how long you've had credit. So if you close credit cards that you've had for a long time, that could make your average age of accounts lower, and that could negatively impact your score. Ideally, again, what they like to see, 2 credit cards, 1 installment loan. So what if you can't get approved for an unsecured card for whatever the reason? Well, you have a couple of options. Number one is what's called a secured credit card, and that's where you're putting the money up front. You can get them for now for as low as $200. So let's say you go give the bank a $200, they send you a credit card with a $200 limit. And my recommendation when you're using that account to build a positive new line of credit, you get the credit card's got a $200 limit. You go down to HEB, you buy $10 worth of groceries, come home, put the card away, wait for the statement to come in, pay it in full, do the same thing every month after that. And after about 2 to 3 months, that new positive account is going to start helping your credit score. Your other option to help your score is to become an authorized user on somebody else's account that has an account that they've had for a long time, high limit, low balance, and they put you on to where technically you could charge on that account. But in a lot of cases, when you're just trying, excuse me, to improve your score, as soon as that person puts you on as an authorized user, all that wonderful credit history on that person's account shows up on your credit report, and that can definitely help your score. If you do have a late payment and it is on a credit card, major credit card, call them immediately and come up with a good story, beg for forgiveness. If you've had 12 months or more of positive history on that account, in all probability, they will give you a one-time mulligan and either not report that late payment or they will delete it from the credit report. Not so on auto and mortgage rates. If you're late on those, getting them off is almost impossible. Next slide. Should you apply for a lot of credit all at once? Typically not. If you start applying for a bunch of credit cards in a short period of time, that is kind of a red flag. And every time you do that, something called a hard inquiry goes on your credit report, and that could negatively impact your score. Now, that said, for auto loans, mortgage loans, and student loans, you can have as many inquiries as you want within 30 days, and it's only going to count as one inquiry. They expect you to look around for different rates and whatnot. So again, you can have multiples within 30 days, only is going to count as one. Next slide. So paying judgments and collections. The two are pretty different when you consider whether you should pay them or not. If you have a judgment against you, you're going to need to pay that judgment if you want a home loan. It is almost impossible to get a home loan approved if you've got an unpaid judgment. Now, paying a collection, that is a whole different animal. You're going to want to look at a number of different things before making a decision to pay a collection, because one of them is, as I mentioned earlier, if you pay a collection and you don't get any points on your credit score or very few, do you really want to do that? And again, as I indicated earlier, does not take it off the credit report. If you're not sure whether to pay, talk to your loan officer or talk to a credit specialist such as our firm to discuss, see what your options are and see what the impact's going to be both on your credit score and the underwriting process for your home loan. Next slide. So manage your credit card debt. I mean, I guess, again, this should go without saying, but hey, let's face it, there's a lot of temptations out there to run out and buy a bunch of stuff and think, well, gee, the monthly payment's only going to be this and I can afford that. Pay down your credit card debt. Get it as low as possible. Ultimately, you want to get your credit card debt under 10% of whatever the limit is on the card. I'll get into that in a little more detail in just a second. Divorce. Divorce is one of the leading causes of problems with credit scores. And the typical example is husband and wife come into divorce court. They've got a couple of car loans. They've got a mortgage loan, all three in both their names. They decide who's going to take responsibility for what. The divorce court judge says that's how it's going to be. But if they don't refinance those loans in one name only, let's say that the husband says, well, I'm going to keep this particular car loan, and he doesn't close it out and get her name off it, and then he's late on that car loan, it's going to show up on the ex-wife's credit report. And even though the divorce court judge said that was his responsibility, that is not going to be removed from her credit report. With regards to credit cards, one of the things I recommend is that you look at your credit card kind of like a debit card, the only difference being that the money comes out once a month instead of every time you use the card. If you do that, you will never be in trouble in terms of not being able to pay that in full, which you want to do because credit card interest rates are crazy. And in my opinion, it drives me nuts seeing people making the banks rich instead of keeping that money for themselves. Co-signing. Co-signing is where you agree to pay on a loan along with somebody else. So if they don't pay, you pay. A typical example would be a parent being a co-signer on, let's say, their child's first car. But the parent tells the child, hey, this is your car. You got to make the payments. Child says, yes, I will. But then a number of months later, they're late on the car payment. And then that late payment shows up on the parent's credit report. So if you absolutely have to co-sign for somebody, my recommendation is you make the payments so you know they're being made on time, and then you go get the money from the person that you co-signed for. Next slide. So let's look at some other reasons other than your mortgage approval and rates to maximize your credit scores. Homeowners insurance. Insurance Journal did a study a few years ago, and they found that people with low credit scores, if you remember, we talked about below 580 versus in the 700s, those people could be paying 2 to 3 times as much for their homeowners insurance as the ones with a great credit score. Auto insurance. Consumer Reports did a study. Does the next slide show the rates on that, Linda? Next slide. Yeah, here we go. So Consumer Reports did a study. They published their results by state. These are the results for Texas. And as you can see, with excellent credit, single adult driver, clean driving record, $1,338 a year. Good credit, a little bit more, about $300. But take a look at poor credit. Over $3,400. That's over 2.5 times as much, almost $300 a month. And if they do that over a 5-year period, that's over $10,000 that the person with the low credit scores is paid more than the person with a great credit score. Next slide. So let's talk about inaccurate reporting. A lot of times when people have credit scores that aren't as high as they would like them to be or as they should be, the reason for that is because there is inaccurate reporting out there. It primarily happens with collection companies. They report stuff, in some cases, quite honestly, they do it deliberately to make the credit score lower than it should be. Their philosophy is if they can do that, they're going to get more money from that particular person that they've got the collection for. So a lot of them do it, and catching it and finding out exactly what can be done. Now, if it's something simple, in terms of raising your credit score, your loan officer will say, okay, pay down this credit card. We're going to pick up enough points to get you to where we need you for this particular loan approval. But when they've done all they know to do and the credit score still isn't where it needs to be, that's when you may want to bring in a specialist, which is what we do. So as credit specialists, what we do is we review the credit report, and what we're looking for is inaccurate, incomplete, or unverifiable information. We know that once we get that corrected or the account deleted from the credit report, that credit score is going to go up. The key, obviously, is it going to go up enough to get your home loan approved? So we find out from the loan officer what score they have to have. Then we review the credit report. And once we've done that and visit with the client, we're going to know whether we can get them from where they are to where that loan officer needs them. We do have bilingual consultants available. So if we have a client that needs or prefers Spanish, we can certainly do that. Typical turnaround time, about 3 to 6 months. And if we can help people get loans approved that otherwise would not have been, then that is absolutely a good thing. My contact information is on the bottom of the slide. So if you have questions or a need to look at your credit score, we'd be happy to help. Linda, back to you.
Thank you so much, Ron. We really appreciate it. So I'm going to go ahead and take over from here. We are going to be talking about what happens. What happens when you go to Miss Veronica and you get pre-approved, or you have to go to Mr. Ron to get everything fixed, and you went back to Miss Veronica to get approved. So once you get that approval letter, that is the first step I request that you have, and most agents request that you have. And the reason why is because what we don't want to do is we don't want to take you to a home and then get the pre-approval afterwards and find out that you do not qualify for the home. So once you get that pre-approval, we're going to ask some major questions like location, place, what is your motivation to move? Do you work with agents, another agent, and the type of money that you will need through this process? And I will schedule an appointment with you. And that's just to help narrow down and identify what is the most important thing to you. Now, several home options. We have the new construction. And if you did not know, Houston ranked number one as the city with the most new construction homes. So if you think that home buyers are not buying, that is not true. We are number one. As you know, in Houston, we have new development popping up everywhere. Even close to me, Sienna is still building after 20 plus years. They're still building new homes. So we have options of new construction. We have options of resale. And resale just means if someone lives in a home and they're trying to sell it, so they're just reselling their home. And if you are not ready, where you go with Miss Veronica and she says, well, we want to get your credit score to this amount, this number, and then you have to go to Mr. Ron. We have something called Lease Now, Buy Later programs, where you can identify the home that you can qualify for, and you can move into it, and you'll have up to 3 years to get everything together with Mr. Ron or Miss Veronica to purchase that home. So there are many different options out there for you. Now, a lot of times people don't know exactly how much money they need. Ms. Veronica did debunk some myths about the down payment, because that's what stops a lot of people. They believe that they have to have that 20% down payment. That's not true. When you get ready to start purchasing a home, you have to have money up front. Now, the basic money that you have to have up front is going to be, number one, your earnest money. Your earnest money is going to be 1% to 2% of the sales price. You're going to have your option fee. And this is just to give you time to have your home inspected. So it's going to be between about $200 to $400 less. It could be a little bit more or a little bit less depending on the home. Now, the next one is very important. It's going to be your inspection fee. You want to get an inspection on a house, whether it's a resale or a new construction house, because you want to make sure that there are no issues with that home before you purchase that home. Your lender is going to require that you do get an appraisal, and that's going to be between $500 and $600. And the reason you have to get that appraisal is because you don't want to buy a house that's not worth that amount of money, and the lender does not want to lend money for a house that is not worth the amount that you're asking for. Your down payment, it varies depending on the type of program you have, and every lender is not equal. Ms. Veronica just spoke about an awesome 1% program for down payment. So if you could do 1% versus 3.5% or 5% or 10%, you probably want to go and ask about that 1% program, because that means that's less money that you have to pay up front. And then your closing costs. The closing cost is going to vary, but it's normally between around 2,500 to 3,000, and it really depends. It could be a little bit less, it could be a little bit more. So what's next? Once you get that pre-approval, we're going to go ahead and find that your dream home, or a home that you just love and you can fix it up. It depends. We're going to go ahead and put that offer in. Once that offer is accepted, you're going to do an inspection. Once that inspection comes back and you're fine with that and everyone has agreed to, if there's anything that needs to be fixed, they'll address it. So once that inspection period is over, your lender is going to require an appraisal, and the appraiser is going to be ordered by the lender. That's nothing that you have to worry about. The lender is going to order that for you. Now, you need to make sure, Ms. Veronica mentioned about your escrow account, and that your home insurance has to be paid up front for 1 year, and the rest of it is going to be in your escrow account. But you want to make sure you know the difference between home insurance and home warranty. Home insurance is going to cover that home in case something happens to that home and protects the lender. A home warranty is in case your AC goes out, or your dishwasher goes out, or your microwave goes out. So that is the difference between a home insurance and home warranty. So if you want to buy a home warranty, normally we ask the seller to pay for it for 1 year, and then it'll cover it. And then after that year, you could choose to extend it if you want to. Once we get through all that, the home has appraised, you went through underwriting with your lender, you've been clear to close, you go to your closing day. And that's it. We are here to make this process as smooth as possible. We do not want you to be stressed. We don't want you to have questions and not feel that you're comfortable enough to ask those questions. That is what we are here for. Our goal is to make your transaction as smooth as possible. Now, I do have one question for Miss Veronica. So I'm going to bring Miss Veronica back up and Mr. Ron back up. And if anyone has any questions, then you could definitely ask the question as well. And you will begin this presentation in your inbox by the end of the week. So Miss Veronica, let me go ahead and unmute you.
Mm-hmm.
I know Ron stated that co-signing,
Mm-hmm.
and I know a lot of parents do that,
Mm-hmm.
and they don't think about 5 years from now, 2 years from now. They just know that their poor child is begging them and asking them if they could please co-sign for a car. And a lot of parents do that. Is there a way that if I co-sign for someone and I want to buy a house,
Mm-hmm.
but I say, hey, I'm not paying that bill, they're actually paying that bill. Is there something that I can do or show you that will help alleviate that debt, or for you to ignore it?
Absolutely. I actually just had that scenario come up this week for a client. The rule of thumb is you need to be able to provide 12 months of bank statements from that person's account showing they have been the ones solely responsible and solely paying that account out of their bank account. It will not work if it's like a joint bank account with you who's applying for the mortgage. It will not work if maybe your son or daughter, if they Zelle you the money and then you make the payment from your account. As tempting as that is, because if I co-sign for someone, I would want to get that money and then make sure that the payment goes out, right? But in the world of lending, mortgage lending, in order to exclude a debt, especially as big as a car note or another fixed monthly payment, you will have to provide 12 months of bank statements. And if that bank statement is 5 or 6 pages, we're nosy. We want all 5 or 6 pages. So it's a lot of work. It's not impossible. But yes, you can do that as long as you show history, a 12-month history of someone else paying it.
So does that also, I know we talked about like a car, but does that also work with the infamous parent loans for student loans for
Yes.
parents? Okay.
Student loans, yes. Yeah, credit
Okay.
cards, no. Credit cards are different. And so it can only be an installment loan.
Okay.
Mhm.
Perfect. Okay. So we are wrapping up. Do you have any last words, Ms. Veronica or Mr. Ron, to share any advice or tidbits or tips for someone that's in the process of thinking about buying a home? What should they do first?
Yeah, I'll jump in. Stay encouraged. It's not impossible, but it's not easy. If it were easy, it wouldn't be the ultimate American dream. It's a great investment regardless of wherever interest rates are at. And it's okay to be an open book to your lender because At the end of the day, your mortgage loan officer is trying to help you, is trying to be, they're going to be your warrior to get into home ownership. So just be transparent. Once you are pre-approved or you're working on your game plan, don't make any sudden moves without telling your lender, because even if even just the slightest little, like, oh, I deposited cash, I had, 500 bucks at home, things like that that you may not think are a big deal to a lender. So business as usual, any sudden moves, just make sure you get with your lender before you do it to make sure you don't stop yourself from being able to be a homeowner.
Thank you so much. Mr. Ron, do you have any advice or tips to help individuals with?
Well, yeah, and again, want to thank everybody for the opportunity to share what I hope will be very helpful information for you. The thing message I wanted to get across is having a really good credit score is going to save you a bunch of money. In addition to, when it comes to home loan approval, it may be the difference between approval and non-approval, as Veronica indicated. So if you have any questions, it can be a little bit complicated sometimes. By all means, shoot me a text, an email, or call me. Be happy to do that. And if your credit score isn't where it needs to be, we'll be happy to give you that complimentary credit report review and consultation to see what the best options are going to be. So in the not too distant future, Linda can hand you your house keys.
Thank you so much. And also, last tidbit, teachers, I understand. I know at the end of the year we're transferring to different schools, different school districts, different positions. I just was working with another agent who was the buyers were, one was a teacher. He accepted a position as an assistant principal, switched districts. Closing was 3 weeks away. We had to change closing and push it back because even though he was still in education, he switched careers, he switched jobs. So the lender had to go back and verify. So, like Veronica said, they're here to help you. If something like that comes up and you're thinking about changing positions, even though you're still in education, they still have to go back and verify everything. So you want to be open and honest, because if they're going to find out and you don't want to delay your closing. Their closing was thankfully only delayed for a week and a half, because he was able to prove it. But make sure that you are open with Ron and you're open with Veronica, because they are here to help. And that's their goal, is to help you get into the home and find the best product for you and help you get in the home for the least amount of money. So once again, thank you guys so much for watching. We really appreciate it. If you have any questions, all our contact information will be provided to you in the email. Thank you again.